Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today, we're sharing 5 stories. First, how Apple is sidestepping a new 100% chip tariff with a $100 billion US investment pledge, a move that's creating clear global winners and losers. Second, a former president is demanding Intel CEO Lip-Bu Tan resign over Chinese investments, as the chipmaker's key foundry division reports a stunning $3.17 billion loss. Third, President Trump is set to sign an executive order that could bring Bitcoin to your 401k, potentially opening up a massive $43 trillion retirement market to crypto. Fourth, we'll dive into Apple CEO Tim Cook's $100 billion deal that moves iPhone glass production to Kentucky and redefines Made in America. And fifth, we're tracking a potential quid pro quo deal as Google enters settlement talks with Donald Trump, a move that could help it escape a federal antitrust breakup. The story begins with a decision that caught everyone by surprise. A 100% tariff on all imported chips was just announced, a move that should have triggered a global market meltdown, but it didn't. Instead, tech stocks are soaring. The reason? A massive carve-out. The new rule from Donald Trump exempts any company that commits to manufacturing in the United States. And the first company to jump on board is Apple. They just announced a staggering $100 billion new investment pledge in the US, a move that effectively lets them sidestep the entire tariff threat. Their stock, along with partners like Broadcom and Texas Instruments, immediately climbed. To understand that number, you have to look at Apple's bigger picture. This new pledge brings Apple's total stated investment in the US to a massive $600 billion over 4 years. It's a powerful signal. What's really at stake here is how corporations use these huge, future-dated promises as a key tool to negotiate with governments. The quiet question experts are asking is, how do you actually enforce these commitments? There are very few mechanisms to hold a company accountable down the line, which raises the question of whether this is a real shift or just a symbolic gesture to avoid the tariff. But that's not the whole picture. The real turning point is that this isn't just about Apple. Tech giants from around the world are getting a pass. South Korea confirmed its heavyweights, Samsung and SK Hynix, will not be subject to the tariffs thanks to their plants in Texas and Indiana. Even the Taiwanese chip-making titan, TSMC, which builds chips for almost everyone, is expected to be safe because of its factories in the US. Its stock just hit an all-time high. Actually, this wasn't just a lucky break for them. These companies saw the writing on the wall years ago. This is a strategy called geopolitical hedging. Facing rising tensions and supply chain nationalism, giants like TSMC and Samsung began investing billions in US facilities long before this specific tariff was announced. They were proactively diversifying away from Taiwan and South Korea to protect themselves. This tariff simply proves their long-term bet was the right one. This creates a clear set of winners and losers. While the giants who invested in the US are celebrating, entire countries are now on edge. In the Philippines, where 70% of electronics exports are semiconductors, the head of the trade body called the tariff devastating. Both the Philippines and Malaysia are now scrambling to get clarity from the US. For countries like Malaysia and the Philippines, this isn't just a policy shift. It's an existential threat. They don't specialize in designing or fabricating advanced chips. Instead, they handle the final crucial steps: assembly, testing, and packaging. To put that in perspective, Malaysia alone handles 13% of the entire global market for this stage. This policy threatens to cut them out of the loop entirely, jeopardizing a massive part of their economy. So the thing is, analysts are calling the 100% figure an intimidating headline, a negotiating tactic of open high, negotiate down. It's a high-stakes move designed to force a reshaping of the entire global supply chain. The impact goes far beyond your phone. Think about the auto industry. One analysis estimates that a similar tariff could add nearly $200 to the cost of the average new car because of all the chips inside. Ford has already projected a $3 billion hit from rising tariff costs. The message is brutally simple: build your factories in America or get ready to pay. The question is, who can afford to play the game and who will be left behind? We were just talking about corporate strategy in a world of tariffs. Now let's turn to a CEO who's finding himself at the center of a national security firestorm. A former president just demanded the immediate resignation of Intel's CEO, calling him highly conflicted. The full quote is highly conflicted and must resign immediately. There is no other solution to this problem. The moment that message hit, Truth Social, Intel's stock started to slide, dropping 5% in pre-market trading. What many might not grasp is how this has become a new reality in corporate risk management. You know, a few years back, JP Morgan even created something called the VolFEF Index just to track market volatility caused by presidential tweets. So what we're seeing with Intel is part of a much larger and more unpredictable trend. But this isn't just about a social media post. This is the boiling point of a national security firestorm. The controversy centers on Intel's new chief, Lip-Bu Tan, who was appointed in March to turn the struggling chipmaker around. What's happening is the creation of a new unwritten national security litmus test for executives at America's most critical tech companies. This intense political scrutiny over past investments and business ties is making it incredibly difficult to attract top global leaders who might see these high-profile jobs as just too politically risky. This week, Senator Tom Cotton sent a letter to Intel's board to express concern about the security and integrity of Intel's operations. The reason? Reports that Tan has invested in a number of Chinese companies, including some linked directly to the country's military. And these aren't just a few minor investments. According to a report from Reuters, Tan's venture capital firm, Walden International, has invested in over 600 Chinese tech companies, with at least 8 of them having documented ties to the People's Liberation Army. This is the kind of detail that sets off major alarm bells in Washington. Cotton is asking if Intel, a company he says is required to be a responsible steward of American taxpayer dollars, forced its new CEO to divest from entities linked to the Chinese Communist Party. He's using that specific phrase because this is directly tied to the Chips and Science Act. When a company like Intel accepts billions in federal funding, it comes with strict national security guardrails. They're prohibited from expanding semiconductor manufacturing in countries of concern like China for 10 years. This public money fundamentally blurs the line between corporate strategy and national policy. You see, this is where the situation takes a more complex turn. It's all happening while Intel is in a state of crisis. The company's critical foundry division, which makes chips for other companies, just posted a staggering operating loss of $3.17 billion. That massive loss points to a deep technical problem. To compete with the world leader TSMC, a foundry needs incredibly high yields, a high percentage of perfect usable chips. For a process to be profitable, you need yields around 70 to 80%. Reports indicate that Intel's most advanced process is struggling with yields somewhere between 5 and 10%. That is a massive and very expensive problem. In response, Tan has been cutting costs everywhere. He's cancelled planned factory projects in Germany and Poland and announced a slowdown for the new chip factory in Ohio. And that slowdown in Ohio is significant. The original target for that plant was 2025. Now, reports indicate that completion has been pushed back to at least 2030. This is a major setback for the goal of bringing advanced chip manufacturing back to the US. So you have a company cutting back on its future, bleeding billions in a key division, and now its leader is at the center of a national security investigation. The man brought in to save the company is now being called its biggest liability. It all begs the question, what is the real end game for one of America's most important tech giants? From a corporate crisis to a potential market boom, it seems the Trump administration is making waves across the tech and finance landscape. The latest move, believe it or not, Bitcoin could be coming to your 401k retirement plan, and it's happening because of a direct order from the top. President Donald Trump is set to sign an executive order that would allow 401k accounts to invest in alternative assets, and that explicitly includes cryptocurrencies. The significance of this move is that it directly rescinds previous Department of Labor guidance from 2022 that warned employers to use extreme care with crypto. By removing that warning, the government is essentially taking a neutral stance, putting the decision-making power and the risk squarely on the shoulders of the companies that manage your retirement plan. And the order isn't just about crypto. It bundles it with other alternative assets like private equity and real estate, potentially opening up 401ks to a whole new world of investments. The market immediately exploded on the news. Bitcoin surged, reclaiming the $116,000 level. Ether jumped more than 4%. And crypto-linked stocks like Coinbase and Circle got a major boost. The potential market impact is staggering. This move could unlock a massive $43 trillion pool of capital from the US retirement market. If you zoom out, you'll see how this could fundamentally change Bitcoin's behavior. If millions of Americans begin automatically investing even a small percentage of every paycheck into Bitcoin, it creates a constant, steady flow of buying pressure. This is a strategy called dollar cost averaging, and it could act as a stabilizing force, potentially smoothing out Bitcoin's famous volatility over the long term. Galaxy CEO Michael Novogratz called it a monster pool of capital, saying the move widens the aperture for buying crypto and will pull more people into this ecosystem. For years, this exact scenario has been called the holy grail for crypto adoption. The goal was to make digital assets a mainstay of US financial infrastructure, not just a speculative trade. This order brings that vision closer than ever before. After all, this is just the latest in a series of efforts under the Trump administration to make the US the crypto capital of the world. But there is a catch, and it gets to the heart of the problem. The path isn't guaranteed. Financial giant Fidelity has already created options to allow Bitcoin in its 401ks, but so far, employer adoption has been low. The reason adoption has been low is because of something called fiduciary duty. Under a law called ERISA, the people who manage your 401k have a legal responsibility to act in your best interest. Offering an asset as famously volatile as Bitcoin creates huge legal questions. If the market crashes, could employees sue their employer for offering a risky investment? This concern has made many companies hesitant, and it's a major hurdle that an executive order alone might not solve. This all begs the question, will an executive order be the final push needed to embed crypto into the retirement plans of millions of Americans? The floodgates are opening, but it's the employers and employees who will decide if the water comes rushing in. Speaking of major economic moves from the White House, we're circling back to that 100% tariff on semiconductors and chips. But in a stunning move, one company is completely exempt. That company is Apple, and the price of their exemption is a jaw-dropping $100 billion. Interestingly enough, the very power to impose a tariff like this is on shaky legal ground. The authority to regulate commerce and set tariffs actually belongs to Congress, not the executive branch. In fact, the US Court of International Trade recently ruled that a president cannot use emergency powers to impose tariffs over long-standing trade issues, calling it a violation of the separation of powers. So this entire deal is built on a threat that might not even be legal. It's a high-stakes game of political chicken, and it seems to be working. Apple and President Donald Trump just announced the tech giant will spend an additional $100 billion on US companies and suppliers. This is on top of a $500 billion commitment made just months ago, bringing the total to a staggering $600 billion over the next 4 years. President Trump didn't mince words, stating, "This is the largest investment Apple has ever made in America and anywhere else." He then added a direct jab at Apple's history of overseas production, saying, "As you know, Apple has been an investor in other countries, a little bit, I won't say which ones, but a couple, and they're coming home." So what does this money buy? A radical shift in the supply chain. Apple is spending $2.5 billion with Corning, so that all glass for iPhones and Apple Watches will now be manufactured in Kentucky. This is a huge deal, but it also introduces a massive risk that isn't immediately obvious. By concentrating all of this incredibly specialized glass production into one single facility, Apple is creating what's known as a single point of failure. One major flood, a tornado, or even a specialized labor shortage in that one part of Kentucky could halt the global supply of iPhone glass. It's a massive bet on efficiency that trades away resilience. The ultimate goal is an end-to-end American supply chain where every part of the chip-making process can happen on US soil. While this is the dream, achieving a truly end-to-end American supply chain is incredibly difficult. The semiconductor supply chain is one of the most complex on Earth. Even if you make the chips and glass here, you still have critical dependencies. For example, the US has very little capacity for processing the rare earth minerals needed for electronics. And the most advanced chip packaging that's dominated by facilities in Taiwan. So while this is a monumental step, full self-sufficiency is still a long way off. This isn't just a handshake deal, it's a direct response to pressure. Apple CEO Tim Cook acknowledged that the president challenged him to do more. Cook's response, "Mr. President, we took that challenge very seriously. Now, here's where it gets interesting. This whole situation redefines what Made in America can even mean for a product as complex as an iPhone. The Federal Trade Commission has a very strict rule. To use the Made in USA label, a product must be all or virtually all made here. With final assembly still happening in places like India or Vietnam, the iPhone won't qualify. But that final assembly labor only accounts for less than 2% of the iPhone's total value. Apple is focusing its American investment on the high value parts, like the chips and glass, which is a much smarter economic play. Apple gets to avoid a 100% tax on its most critical components, and the White House gets to declare a monumental victory in bringing manufacturing back home. But there's one final hurdle. It's not about money or factories, it's about people. The Semiconductor Industry Association projects that by 2030, the US will be short nearly 70,000 skilled technicians and engineers needed to run these new plants. We can build the factories, but do we have the trained workforce to fill them? That is the next great challenge in this story. From one tech giant navigating a deal with the White House to another, a situation is brewing that has Senate Democrats crying foul. Is Google about to cut a deal with Donald Trump to potentially save itself from being broken up by the US government? That's the explosive question being asked by Senate Democrats right now. They're sounding the alarm over what they call a potential quid pro quo arrangement between the tech giant and the former president's legal team. Let's unpack what's going on. Trump has a 4-year-old lawsuit against YouTube, which is owned by Google, accusing it of unlawful censorship after his accounts were suspended following the January 6th attack on the US Capitol. A settlement here could set a dangerous precedent, creating what some experts call a too powerful to deplatform carve-out. It raises the question, can powerful political figures be exempt from a platform's own rules? Recently, court filings revealed that lawyers for both sides are engaged in what they call productive discussions and have asked the judge to delay a hearing. This is where it gets intense. Why would Google be so eager to settle? The company is facing down the barrel of a federal antitrust case that it already lost. A judge could rule to break up the company at any moment. The key to understanding this is that a friendly presidential administration holds immense power over the Department of Justice. The president appoints the Attorney General and the head of the Antitrust Division. Through these appointments, an administration can signal its priorities, potentially easing the pressure on a company like Google. Google also has multiple open cases from the National Labor Relations Board. This is a front that's often forgotten but critically important. The executive branch has significant influence over the NLRB. A president can appoint or even dismiss board members, which can effectively paralyze the board and stall cases. For Google, which is facing allegations of retaliating against unionizing workers, a friendly administration could mean these labor disputes simply grind to a halt. The stakes could not be higher. In a letter to Google's CEO, senators laid out their concerns, stating they are worried Google could settle the lawsuit in a quid pro quo arrangement to avoid full accountability, and that it could result in the company running afoul of federal bribery laws. This isn't just about making a nuisance lawsuit go away. What we're seeing is a new kind of corporate strategy. Experts are starting to view these settlements as a form of proactive political risk management. It's a calculated investment to preemptively curry favor with a potential future administration, hoping to smooth over regulatory hurdles down the line. After all, other tech giants have already settled similar suits with Trump. Meta reportedly paid $25 million, and X settled for around $10 million. The senators also pointed to a history of connections, including a $1 million donation from Google to Trump's inaugural fund, and reports of Google's CEO dining with him at Mar-a-Lago. Now, to be fair, the situation presents a fascinating duality. On one side, you have these allegations. On the other, Google has its own powerful argument against being broken up. They claim that dismantling it would directly benefit China's tech sector, especially in the critical race for AI dominance. This adds another high-stakes layer to the entire fight. This all leads to one massive question. Is this just a standard legal settlement? Or is one of the most powerful companies in the world making a high-stakes play on the future of American politics to ensure its own survival?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.